You're going to look at 3 to 5 year horizon. So you're not too interested in the short-term noise, what's happening with the US dollar in the Eurozone, although we will take that into account. We do look at that. That's not saying that's going to influence any of our investment decisions. We're more interested in your fundamentals, so we look at the long-term fundamentals of the companies and of the sectors. We'll look at the trailing PE ratios, price to book ratios, dividend yields, that sort of thing. So not too worried about the short-term noise.
So what's happening in terms of your portfolios at Cannon Asset Managers at the moment?
Over the last year, we were underweight resources. We have been overweight financials and industrials. That was a good position to be in, obviously with financials having run, as well as industrials relative to resources. Now we've seen a pure valuation view that resources are beginning to catch up on valuations. So we are moving more towards an overweight, or not an overweight, but we're increasing
your position in resources.
Decreasing, sorry, our underweight
but now
resource position.
You are specific about which stocks you are investing in. So what would be the flavour of the 3 to 5 year view at Cannon Asset Managers in the resource space at the moment?
As a value investor, you tend to go for your unloved stocks. Sasol is one of our big holdings in the resource sector. It's got bad sentiment around it with its recent fine. It's lagged the markets, and we expect that to recover over the next year, 2-3 years.
So you must be net bullish on the oil price, which we know is rallying at the moment. We're above $86 a barrel.
It has rallied,
now.
but it also has lagged over the last few months. It has lagged your copper and gold prices. So we do expect the earnings to recover going forward. Another one of our big positions is Anglos. That's a new position that we've just moved into. We sold out of Hulamin, Exro and ARR, or African Rainbow
But
Minerals.
Anglo-American's already run quite hard since it was unloved.
It was unloved. I think it still is quite unloved. It has run hard recently, but it also has lagged. If you look back over the last year, it has lagged the resource counters, or your general diversified miners. It's gone through a rough patch. We obviously know Anglo Platts had to go and have a rights issue. They cut Anglos as a whole, cut their dividend last year. We expect that dividend to be reinstated. And resources for a value investor, it's a very difficult animal to deal with. Past earnings mean absolutely zero. Forward earnings, no one knows what they're going to be. So it's a slightly different take that you have to look at resources. So we look at it through the cycle earnings, and on through the cycle earnings, Anglos is looking quite cheap.
And what emphasis do you place on management in a decision like that, looking at Cynthia Carroll and her team?
We think Cynthia Carroll took over probably at the wrong time. I think she's taken a lot of flack for previous indiscretions, cash flow problems, that sort of thing. We do look at management. It's not a defining point.
So sector rotation happening at the moment. As you say, you've capitalized on the run that we saw in financials and industrials. Does that mean that banks are no longer a go area for you?
I wouldn't say sector rotation. We're not going overweight resources. Let me make that clear. We're just decreasing our underweight position. Banks have run quite hard. Within financials, life insurers still look attractive. Banks have run quite hard, so they're looking fairly valued at the moment.
We'll come back to you in just a moment. On the line, we've got Tom Cochill. He's the Director of Commodity Sales at Standard Chartered in London. Tom, what do you make of this commodity rally? We've got oil holding above $86 a barrel. We've got gold at $1,146 an ounce and platinum holding above $1,700 an ounce. Can we go higher from these levels across the board, in your opinion?
Yeah, I think so, certainly, especially with the precious metals. I think we've been expecting this bounce for a while. The correction, the pullback, particularly in the gold price, was predominantly due to a period of dollar strengthening. We anticipated that over the last couple of months. And the gold price has really not gone particularly high based on investor demand. I think the lackluster investment in the equity exchange traded funds, but also in the COMEX. I think there's been some liquidation in the COMEX positions as well, as the gold futures have descaled and scaled back a little bit. But this run up that we're seeing at the moment is mostly being driven by a renewed interest in physical gold. I think we're definitely seeing some buying here as people look at Europe and consider Eurozone fears. I think it's a continued theme for the last month or so as we look at the macroeconomic health of Europe generally. and are very concerned about the euro. And as people are pulling out of euro and buying dollars, but they're also moving into tangible gold as well, and buying gold as a safe haven currency at the moment.
Tom, do you
think that bounce is going to continue?
Yeah, do you believe that?
I'm sorry?
Do you believe that gold is a better alternative than the currencies that you've just mentioned, the euro and the dollar?
I certainly think that there's been a lot of focus about what central banks have been doing with their reserves, and the big question mark, I think, in a lot of the international community's mind has been, what's China doing about its reserves? There's been some data out over the last week about China actually reducing its dollar reserves, and where that's going at the moment is a big question. Is it going into gold? Are they buying a lot of gold in the Chinese State Reserve Bureau? And I think that the probability is that there is some open market buying taking place. There's no big loud announcement about buying IMF gold taking place, which I think was probably, if you looked at the market 6 months or a year ago, I think there's a lot of theories in the market about central banks moving into gold as an asset, as an investment trade. But at the moment, it looks like the gold is picking up from probably, in our estimate, this is really going to be lasting for the next sort of 6 or 9 months, while we kind of see some concern about the US rate rising cycle coming in probably, third quarter of next year.
When you say gold,
generally speaking, historically, gold's done very well ahead of that.
If I can get a target from you on the gold price, we've got the likes of Jeffrey Nichols, who's the managing director of American Precious Metals, saying that gold is going to $1,500 an ounce by year end, and then $3,000 beyond that. Is that a little bullish for you?
We have a slightly different projection, I'll be perfectly honest. I mean, I think, we look at, as we head, what we're looking for at the moment with the gold price is basically following along the lines of what's happening with the US dollar interest rate rising cycle. And we're now calling, I think originally, probably if you went back a couple of months, we would have said first quarter of next year, rates would start to rise in the US. Ahead of a rate rise in the US, gold has generally done very well and started to perform. We kind of see sort of like 15 to 20% growth in years, in the months preceding a rate rise cycle in the US. We now think that's probably going to come in the third quarter of next year, and then after that, gold start to suffer. So our projection is like $1,300, probably towards the end of this year, and then in 2011, average prices are about $1,100, softening down to probably about $1,900 in 2012. So slightly different outlook. Certainly we see some short-term bullishness for gold, definitely.
Well, let's come to platinum, sitting now at that $1,713 an ounce level, and what the fundamentals are saying about the platinum price. Having spoken to a number of commodity analysts of late, it appears that platinum is going to move from a surplus situation to a deficit situation as demand outstrips supply this coming year. Do you concur with that view?
Yes, certainly. I mean, we have grave concerns over, especially, the power-producing capability of sub-Saharan Africa, and exactly what's going to happen as we look at South Africa, and is it going to be able to meet its power needs to be able to continue mining and producing significant amounts of platinum to cope with this voracious demand. We already anticipate a large demand from a burgeoning autos business out in China. The next question is, how quickly is the US going to rebound? I think Europe has seen some signs. There's a lot of concerns over the general health in Europe, but the US is now starting to look like it's going to perform. We looked at China. There's massive growth expectations there for auto sales, and the biggest producers of platinum, how are they going to cope with a tougher environment to be able to source power from the grid to continue to produce metal at the demand required.
$2,000 an ounce, are we going to push through that in the short term?
It doesn't seem that far away to me, to be perfectly honest. I think the fundamentals have been definitely helped by the new creation of a new buying class, the investor, who can now buy platinum in paper form on the ETF. And I think that since this year we've seen big inflows of real money into that sector, and that's just opening up the platinum spectrum to a whole new environment for a buyer. It's not just about the industrial buyer now, it's also about the investment buyer, and that's a very big trend. If it's anything like we saw in gold, we will look for a 2- to 3-fold increase over the coming years, and that's a significant increase in the amount of demand for the metal.
Tom, let's just switch to base metals. What do you make of copper recently touching $8,000 a ton? We're back now at $7,900 a ton or so. Can it go back and push through $8,000, or are we looking at relatively ominous levels, given the fact that the last time we went through $8,000 a ton, we fell all the way back down to below $3,000 a ton?
Absolutely. I mean, I have to be very quick and point out the world is a very different place, and I think our understanding of the dynamics of demand for copper in the world have changed somewhat since that occurred.